I don't have to pay $83,000. I thought it was almost illegal. I was like, what?
If you're on social media scrolling, every other post or reel that your algorithm is going to pull in is going to be about passive income. Passive income creates freedom. Passive income allows you to vacation whenever you want. And you see these people on yachts and people driving supercars. You don't have a business. In your perception, you have a business, but you really don't. What you've done is you've bought yourself a job. Because if you step away from that business completely, spending 3-4 hours a week on that business, then
what is a bare minimum take for you to survive? A little bit maybe higher, maybe add another 10, 20% for comfort, and that's what you're trying to replace. You're not replacing the dream that you're looking the yachts and supercars. That's not where your mindset should be. Your mindset should be, what can I replace I'm comfortable with today?
principal pay down is not a write-off. So you need that depreciation that you're going to get from that purchase to offset the $10,000 a year in income that you're making. Or the next thing you know, you have an additional $10,000 of income on your income tax that you have to pay tax on based on your tax bracket because you don't have any depreciation to offset it. So don't confuse principal pay down for an.
This is the Cash Poor Asset Rich podcast. I'm Mickael.
I'm Amer.
We break down real estate in a way that's simple to understand,
Easy to relate to.
and practical enough to act on.
Let's get started.
What does passive income mean to you?
Pretty simple, right? I mean, it's almost self-explanatory. Passive income meaning income that comes to you that you don't really have to put in any dedicated hours to earn that income, also known as mailbox money. And the reason why it's called mailbox money is because you open up your mailbox once a month or once a quarter, you have a check, and your responsibility is to deposit that check into a bank account and collect the fruit of your investment.
Okay. I know. I mean, there's a huge, like the buzzword happening everywhere. Any social media, passive income, this, they make it seem as if it's so simple. Is it really that simple? Or like, I would love to like have a real life example here, like how people are making it seem like, because nothing bothers me more than when I see social media and how easy they make it seem. And I think we've talked about this before, where it's not really reality. It's like when you jump into it, it's when you realize all the mistakes you're making, all the crap that they didn't tell you. And you're like, hold on, I am basing everything I'm doing based on everything I've been reading or looking at these gurus doing it. How come it's not the same in my life? And then maybe people get turned off by it because it's not the perspective that they saw based on what they're looking at and got them hyped about it. What does passive income actually look like in real life?
If you're on social media scrolling, looking at posts or reels that have to do with passive income, having to do with earning supplemental income outside of your full-time job, every other post or reel that your algorithm is going to pull in is going to be about passive income. Passive income creates freedom. Passive income allows you to vacation whenever you want. And you see these interesting posts with people on yachts and people driving supercars. And hey, how did I do this? I did this with passive income because I have so much passive income coming in. And I think that whole movement really stems from that time is a finite product. We only have so many hours in the day to work. We only have so many hours in the day to sleep, spend time with significant others, spend time with families, go to our kids' football practice or baseball practice or any sports that they're involved in. So how do you really elevate your income if you're used to substituting time for money? And this is where the passive income movement has started, is let's show full-time earners on how to increase their income by having a passive vehicle outside of their full-time job or their business or any consulting gig that they do that requires their time, their physical presence, or their mental time to be able to quantify that into a living. And the passive income component comes in, okay, well, you have your full-time job, you earn your full-time paycheck, you have your full-time business that you're involved in that's taking up 30, 40, 50 hours a week. In fact, I was listening to a podcast a couple of days ago, and they're saying that there's a movement right now in California, specifically in the San Fran Valley, because of the revolution of AI, that people are back to working 6/12 is what they call it. What is 6/12? 6/12 is really working 6 days a week for 12 hours a day. And the reason why this is becoming popular, oh, and they also said, 6/12, lift heavy, eat good, don't do any drugs. That's the movement. That is the movement. So the expectation right now in Silicon Valley, if you're involved in AI and you're a young tech guy, is to do 6/12, lift heavy and eat well and not do any drugs. Okay. Well, let's quantify. What is that? That equals to 72 hours a week of work.
Yeah.
What is left in the
That's
day?
so
Therefore,
I'm all for, sorry to cut you off, but I'm
Yep.
all for, I think it starts being active. You can't just walk into, unless you have a crap load of money just sitting around or you are inherited something. You can't really, you have to start active before it becomes passive, right? I mean,
where's the passive going to come from if you don't have any active
right.
money to deploy into a passive vehicle?
Very true. Very
You
true.
have to
I mean,
start
we'll get
active
into that. Absolutely.
unless you have an infinite amount of money that you've inherited through a trust fund,
Right.
or you just have access to old money.
Yeah.
Then it's a different story. But this podcast is not intended for that. This
Yeah.
podcast is
Very
intended
true.
for our high earners, our business owners that have a healthy business or have a healthy W-2 job, that are really looking to see how they can deploy their money into other vehicles outside of the normal channels, as we know, through your contact at Charles Schwab or your contact at JP Morgan to buy a managed securities portfolio.
Yeah.
That's kind of what we're discussing today, is how do you generate passive income through other vehicles?
Right. Like for me, like I have learned over the years, like I was very active in my businesses and then realized, the power of delegation, right? The power of delegation. So you can, that way you're starting a business, you're active in it, then you delegate and then you just kind of like almost watch over it. And I've done better and better in my years being in business. And yes, I would say I'm now more on the passive side because the way I do it is I bring in operators and I work with the operators. I don't work with anything that is running the show. I'm just kind of working on the business rather than in the business. And we hear that a lot. And I kind of put that in perspective in turn, like, okay, I need to do this. I really need to just work with one team member, which is the operator of the whole business, instead of like, and hope, and trusting that person. So I built that mindset. It wasn't early on. I mean, like we just talked about, it goes from active to later it being a little bit passive. And you can do this in multiple vehicles, like you said, different maybe assets. And in my side, I started doing that with business. And while it's great, it's not real estate. It's not the same as real estate because yes, I am not spending as much time. I'm making money from the businesses that I'm not spending enough time in. But what am I doing with that money at the end of the day? What am I investing it in? So passive income can be, at the end of the day, you can put truly, if you really come down to it, the only passive income where it doesn't require much activity on your side beside pressing a button is stocks, because you can literally just wire money, send it in, and then just watch it grow. And you can put it in the S&P 500 because historically it's been going up whatever 8, 10+% over the years. And just let it sit there. Now you're completely passive. And then it just whatever if you chose to reinvest the stuff. But is that really like, I don't know. To me, it's like you want to just enable your mind completely from, because real estate, you could potentially get to that side, and investing with sponsors, but you still have to know a little bit, like what we talked about earlier in the shows, that you need to understand who the sponsor is, and before you give them money. Stocks, you don't have to trust it. You're like, okay, S&P 500, here's my money, and let it ride the wave. But in investing in real estate, it's a little different.
So, we're going to jump into that, but I think that there's something that our listeners can benefit from. So you said that building passive income doesn't necessarily have to be through a stock vehicle or an annuity or buying bonds. Let's talk about building passive income through a business, like the way you do things. You identify a business, you delegate or recruit somebody who has the know-how of how to operate that business, and that can be done through any of the recruiting channels, whether it is Indeed, whether it is LinkedIn, or through your direct network. But what's, I think, important for our listeners as well to know is, how do you identify what business you're pursuing? So if I am a W-2 guy and I am working at General Motors and I got a great package, I'm making $200,000 a year, I have full health benefits, I have retirement 401k, I have paid vacations, that's great, I have supplemental income, and I want to take that supplemental income and start a passive business. Where do I begin looking? What's trendy, and what can I start that doesn't really require me to be an owner operator, so I can achieve that passive income? And then what we're going to do is we're going to take that, we're going to add it to our supplemental savings from our W-2 position, combine those two, have additional liquidity, invest into a third bucket, which potentially could be real estate. So let's talk about that, because I think that this is important for our listeners that are looking to start a business, looking to elevate their income, create more investable dollars to be able to deploy it into real estate.
I think both ways. So when I said, as far as like my side of things, I still spend a minimum of 1 to maybe 3 hours a week for each of my businesses working with the operator. Now, if you're a W-2, sorry, say that again.
With the integrator.
With the integrator, exactly. Somebody that's actually doing all of the work inside. But it took me years to get there. And if I want to completely be completely out and not even spend those 1 to 2 hours and 3 hours, because in the beginning it doesn't take just 2-3 hours, because it takes me about 30 to maybe 50 hours per week if I'm recruiting for that person, because I want to make the right hire. So as they say, hire slow, fire fast, right? So I take that very serious. But when it comes to, if I'm a W-2 earner and I'm very busy, I clearly, I don't have time to manage a business or anything, because this topic is all about passive. What I would do is either invest with someone in business, where there are platforms out there that you can, invest your money into businesses and have no say, or friends and family that have businesses and are like, hey, we need capital. You can invest with them if you've done some kind of homework into maybe something you're passionate about. But that's truly passive. Now you become an investor rather than being into the game, in the game. And that will start giving you income from different sources for you to start, maybe, I don't know. I mean, even though this podcast isn't for people to just want to leave their job, and we have other episodes talking about that, but it's about replacing you, like income that replaces you. So that way it's not really tied to all of it's not about you. It's about how that money, it's making you money regardless if you're putting your 2 cents or not, it's still making you money. So that's truly what passive income for me is. And I'm sure for many hoping, beside what we see on social media of, like you said, the yachts and all of that. Yes, they're painting I want to say they're painting the dream, but it's the wrong dream. It's a really bad picture because it's kind of almost like it makes our mind think, wow, we want this, but then the reality is so far fetched from it. And I think if you want to invest, if you want to start, I think investing with someone else is really the way to go, especially in the beginning, for you to kind of understand the business. And hey, just because you're an investor, it doesn't mean you can't ask questions. I'm a curious person. I will always ask questions if any investments I make. So somebody will come to me and be like, "Hey, I have we have an investment opportunity for this type of business. We need whatever silent investors, as they call it." I'm not silent. I will ask questions because even though my money is passive, I want to learn. I want to understand how this really works because the more I can learn and understand, I'm just putting that into my toolkit.
But you have the time to do it because you're not involved in a full-time job. Therefore,
Exactly.
our listeners that are involved in a full-time job, what you're recommending here, and just to kind of summarize our conversation over the last 5 or 10 minutes, is pick investment vehicles that you don't need to spend your 30, 50 hours a week recruiting the right talents, building a business, and then passing it on to an integrator to be able to do it, because that becomes very cumbersome for somebody who's involved in a full-time position or another business altogether. And they're an
And it takes skill over the years to build that, to be able to do that.
Yeah.
It doesn't come overnight. 100%.
So the recommendation rather is know some high level about your passive investments and trust an expert to steer your passive investment on your behalf.
Absolutely. That's what I would do. Until I know a lot of people say, "Oh, until it replaces your W-2 or your income, it replaces your income. That passive income is replacing your income. Then you can start working on other things." But at the end of the day, it's about your lifestyle. If you're making $300,000 a year, and you're blowing all that out on whatever your lifestyle,
You're not going to have any
then
money to invest.
not only are you not going to have any money to invest, but you're going to always climb that, because now you're replacing your W-2, you're trying to replace. So now you're on your passive side, maybe you've made some investments and now you're making an additional 100,000. Or guess what? If you're a person that lets your lifestyle creep up, it's going to creep up. And then where is the end? I would say, what is a bare minimum take for you to survive? A little bit maybe higher, maybe add another 10, 20% for comfort and let's say vacation. Obviously, we're human. We want to enjoy life, right? At the end of the day. But where it's not pushing the bar too high, that's what you're trying to replace. You're not replacing the dream that you're looking on social media with the yachts and supercars and all of that. That's not where your mindset should be. Your mindset should be, what can I replace that I'm comfortable with today, like now, or maybe even take a little bit step backward because I know the future, so I can play the infinite game, right, rather than the finite game. And that's really where it's at. So once you know your passive income has replaced it, and if you're the person, hey, I don't even enjoy my job, I want to leave it, or this is for any high earners. It could be an entrepreneur that's listening in, because a lot of people think, I'm an entrepreneur, I own a business. I think that's bullshit. And the reason I say that is because if you own a business and you're working inside the business, my friend, you're not an entrepreneur. You just found yourself a job.
You bought yourself a job, and
you bought exactly.
I said that to somebody that's in my social network about 5 years ago, and that person took a big offense to it. They're building this business,
Yeah.
that's trendy, that's cool. There is social media presence for it. There are cool products. Uh, Incoming phone calls are coming in for orders. But my question to that person is, how involved are you in the business? They said, well, we're still putting in 50 hours a week. I'm still doing the
Yeah.
work. I'm
Yeah.
like, I wanna be blunt, but I don't want to be rude. So
Yeah.
I want to let you know that you don't have a business. In your perception, you have a business, but you really don't. What you've
Yeah.
done is you've bought yourself a job. Because if you step away from that business completely and you're only making executive decisions with some of your management team, spending 3-4 hours a week on that business, then we can validate that you did build a true business. But if you're still in there 50 hours a week, you bought yourself a job. Now you got to evaluate.
100%.
You got to evaluate, this job that I bought myself, running my own business and controlling my own schedule, in comparison to working in the corporate world, specifically in corporate America, with the skill set that I have, with the educational background that I have, because there's also a point of there's a barrier of entry into corporate America. Most jobs are going to require some sort of a bachelor degree. So what we're going to say is we have the bachelor degree already. That's already been established. I am somebody with this type of experience. Can I replace what my business is bringing in through a W-2 job? Yeah, it may not give me as much freedom in terms of schedule, but I can assure you that you're going to be working a lot less and your problems
Hmm.
are in somebody else's hands. You don't have
Yeah.
to worry about, with that particular job, you're not worrying about how healthy your balance sheet is, how healthy your P&L is. Are you meeting projections? Are you meeting goals? Do you have enough cash to be able to ride the seasonality of your business? Do you have enough reserves to be able to continue investing into your business? The silent killer is the reserves that people don't really sometimes underwrite within their business. They buy a brand new business 5 years later, their business is completely dated. Customers are not coming in. Volumes are crashing because there hasn't been a reinvestment in the business, and they really haven't even allocated any type of reserves to be able to do a reinvestment. So
Yeah.
that's a big silent killer to the business. But if you take that, all of these problems that come with business ownership, with the skill set that I have today as an individual and with my educational background, can it get me a job in corporate America, get full benefits where I don't have to pay for my benefits, get paid vacations, get a retirement plan with some sort of a match from my employer? Is that the better fit? Look at the bigger picture, look at the global picture. And
Yeah.
it might be invite anybody that's listening to our podcast to go through that exercise, especially if you're a
Yeah.
business owner that's still spending a tremendous amount of time in your business.
Absolutely. I think you're saying a lot of amazing stuff. And Steve Jobs hit it right on the nail. And one of his quotes, my favorite quote, I'm reading it exactly. I'm looking at his quote right now. And he said, it doesn't make sense to hire smart people and tell them what to do. We hire smart people so they can tell us what to do. And I take that and apply it to everything. And the reason I do, and this is for anything, like what we're talking about, real estate, like if you want to find a sponsor, yes, you can go out and do it all on your own. Nobody's going to stop you 100%. Is it the smart thing to do? No. And the reason, because you're trading your time still. It is your time. For me, there are other experts, even if they're at 70, 75% as good as what I think I am. What I think, obviously, me saying I'm really good at something, it's a perspective. It's very subjective of what I think of myself. But bringing in someone that knows the industry or is an expert, and if I did a great job bringing that person in, I should trust them. No matter if we're talking about business or segueing this into the sponsor or a family member that I'm investing my money with.
Definitely. So, I wanna touch base a little bit about hiring somebody who's smarter than we are to elevate and take your business forward.
Yeah,
I see that in a business that I own and operate in the family entertainment industry. We have about 300 employees. Our entire workforce is of the ages of 14 to 20 years old. Incredible how much these kids know. It is absolutely mind-boggling. Relying on that workforce and letting them run your business with guidance is a game changer for us. Their social media presence, the content they put out, the way they engage with our guests, the ideas that they come up with. Compound that with something that I experienced yesterday. I was at a coffee shop taking a couple of my calls from there, had my laptop open, and right next to me was two kids. If I were to guess, they were probably 16 or 17 years old. And they had their laptops open. They were watching the market live. And I can hear them talk. And they're crypto day traders. Crypto day traders. And they're young, 17 max, if I were to guess. The amount of knowledge these kids had on their craft at age 17 was incredible. Like, I'm listening from the outside. I'm not a crypto guy. I don't know much about crypto, but I can hear the lingo. I can hear the way they're communicating. I can hear what they're doing on their laptops. I can hear how they're placing orders and they're calling out shots to each other. Hey, we should be selling right now. Let's hold. Let's see how the next few minutes roll out. And it was just incredible watching them. And these guys are still young entrepreneurs that are starting their life out and doing some great things. So this really segues back to what you were saying about Steve Jobs' quote is, whatever that we got to do, we just really have to hire people that know more and smarter than we are and rely on them and rely on what they've learned over the years, because I think that will just make us better people and better business owners and entrepreneurs.
Absolutely. Absolutely. As far as like investing, how like is this more about being consistent than being perfect? Like, do you need to make a perfect decision every single time before you let your money go? Or is it okay to because obviously nothing is perfect, right?
Yeah, there is a craft to this. Are you going to be a 4.0 student every time you invest? Reality tells you otherwise. You're not. So you have to be willing, and we've talked about this in previous episodes, whatever money that you invest, you got to be willing to lose and risk that money where it does not have a catastrophic event to your life. If I put in $50,000 into a deal today, I got to be able to afford losing $50,000 without having my kids on the street because I've lost that $50,000. Number one rule for investing is you have to be disconnected emotionally from the money that you're investing. Frequency will provide you more diversity. Diversity will provide you more risk tolerance. The more diversified I am with my business, with my investments, and particularly in real estate, if I have all of my money into one deal, it's a lot riskier than having a quarter of my money in 4 different deals.
So it's also about, like you're saying, like when you say frequency, you're talking about being consistent in investing.
Yeah, you got to be consistent because I mean, what's consistency is going to equate to higher frequency. So I would say for anybody that's that wants to be in a real estate deal, and we talked about our high earner that's making $300,000, giving $100,000 of it in income tax to the IRS, having $200,000 available in net income, of which they may live off of $150,000, saving 25% of their income, which is a total of $50,000 that could be deployed into real estate. If you're able to put away $50,000 a year, put it in real estate, well, fast forward 5 years from now, and you're doing one deal a year. Fast forward 5 years from now, you're going to have 5 different deals. And the nice thing about these deals is most of these deals that you see out there through a sponsor or through a syndication, they're 3, 5, or 10-year plans. So if your investment profile is to invest into 5-year deals, and there is a business strategy that you're going to get your equity back within 5 years. Well, at year five, and you're focused on investments that are going to generate a 2x multiple. Well, in year five,
Yeah.
you just got what you invested in year one, which is the first $50,000 that you've invested, in addition to an additional $50,000 because the projections showed that you're going to get a 2x multiple on your money. Now you got your first principal back that you put in 5 years ago. In addition to that, you've put in an additional 50,000. You've earned an additional $50,000. Now in year five, you can do 2 deals instead of 1 deal a year. This is assuming that you've maintained the same income, assuming that you're still at $300,000 a year
Sure.
with your full-time job, and you have $50,000 of disposable income to invest every year. So there's some sort of an avalanche effect that takes place, and this is why frequency is important.
Yeah. Okay. So that's great. And now, once you've made your first or second or third investment, how important is reinvesting instead of spending early, like the early profits from those investments? Is it like the power of compounding? But how important is it? Is it really going to make a huge difference?
The power of compounding in real estate not only is going to make a huge difference, but also it's going to shelter your gains from tax obligations. Like
Okay.
you gotta really understand that this is not a cash out play. If you want
Sure.
to continue investing almost tax free, you got to be willing to re-roll your profits as well as your principal into the next deal. And you continue
Okay.
doing that until you want to completely exit and retire. At that time, you're going to have to pay your dues. Okay? It's just the name of the game. It's deferred, but it's not forgiven. But you're at least growing it tax free. Just like
Yeah.
a 401k, it's pretty much the same concept. You're growing it tax free, but your obligation is only deferred, it's not forgiven. And that's what we want to
Yeah.
do. We don't want to start paying obligations after deal one goes through its full cycle. We want to continue rolling that money into the next deal and next deal so we can grow it tax free and defer those taxes until it's time to pay Uncle Sam.
Okay. So
Everybody's
it's
going
a
to have their
similar,
judgment day eventually. Okay. Everyone's
of
going to have their
course.
judgment day eventually. But let's
Yeah.
try to reap the benefits without having any tax obligations until our judgment day.
So is it, if we had to compare this to like the tax side, so I invest in, let's call it the S&P 500. I can't recall if the S&P 500 pays dividends or not, but maybe it does. Maybe I think it does. But let's say it pays dividends, and the dividends are what we're like giving you guys example of what the early profits are. And it really matters. Like here, are we, because when you do when you're doing stocks, there's a button or there's an area where you go and you choose, I want to reinvest my dividends back into purchasing another stock or whatever it is. So is it similar to that, Amer? Is it like instead of the dividends being now income, now they're just being reinvested where it's part of the investment. So on the tax side, it doesn't show you're making that as income, and you're letting your empire pretty much in the S&P 500 compound.
So I would compare dividends in the stock market to preferred returns in a syndication.
Okay.
The investor is earning a pref on their equity,
Yeah.
which is ultimately what you're getting for dividends. Dividends are paid based on what you've invested. Now, the stock value can shift, can appreciate, depreciate, but you're still making dividends based on what you've invested. Similarly with real estate, you're going to get a
Very true.
preferred return. In
Yeah.
addition to the preferred return, if the business plan is executed properly, then you're going to get the value creation in addition to the preferred return. The preferred return in a value add deal is typically accrued and paid
Yeah.
either at the event of a sale or a refinance, depending on what the business plan is. And the value creation is also paid at the refinance or the sale of the property. However, what happened systematically is when you purchase that asset, We accelerate depreciation through a cost segregation tool. So you have this like negative bucket of negative income. And then if you are receiving distributions,
Yeah.
those distributions are just funneled into that negative income bucket. And the negative income bucket is shielding the tax obligations of those distributions. Now, if you're not receiving distributions, because this is a value add and value is created at the sale, okay?
Yeah.
Or at the
Got it.
refinance, you have this depreciation bucket that's going to shelter your distributions that you're going to receive at the time of sale. And in the event there's excess profits above and beyond the distribution or the depreciation that you've received in year one of ownership that's been just chipping away from the sale of the asset, then what you got to do is there's going to be a recapture. You sold the asset, so the depreciation that you've taken in year one, what you have to do is you have to recapture those write-offs because the asset is sold, the asset is no longer in your portfolio. But what you can do is you can take that positive gain that you've achieved over the 5-year ownership and then roll it into a 1031 exchange. The 1031 exchange allows you to buy another asset that's like for like, and it needs to be identified within the first 6 months of a sale. Once that is identified, the IRS tells you, well, if you buy a like for like asset at the same price as what you sold your previous asset for or higher, what you can do is you can roll those profits into the next acquisition, and those profits would be tax free.
So not to go too deep into this, you're saying like for 1031 for those who are listening, or even for me to understand. Does it have to be like, let's say it's an apartment building that I'm selling? Does it have to be an apartment building, or it can be just another real estate deal?
It could be another real estate deal, Mickael. Like for like, it means that you can't go and sell an apartment complex and go buy a yacht. Okay.
Or buy a business.
Or buy a
Can I
bit.
buy a business?
Sure.
Yeah. Okay. Got it.
Yeah.
So it needs to be like in the asset, when you're saying asset class, like real estate, it needs to be something tangible.
That's right.
To be able. Got it. Okay.
That's
And
right.
we talked about the picture that, social media paints. When does someone feel like, okay, this is working? This is like, I see it. Like, when does that happen?
Depending on your investment profile. If you're investing into a value add vehicle and the business plan doesn't call for profits until year 3, then you're just accruing it. You have what we call unrealized returns. Okay. You're accruing it, but you haven't realized it yet because a refinance or a sale didn't take place. The question is, how do you look at your investment? Similarly, like I always like to bring stock because a lot of our listeners are probably stock traders. If you buy a stock for $5,
Okay.
and stock value goes up to $5.50 and you're getting a 3 or a 4% dividend on that, the account is growing. You see it, but you're not realizing those gains because you haven't cashed out. Just like being, for example, going to the casino and playing roulette, and your chips are growing, but you haven't cashed out. You have an unrealized gain. So real estate is similar to the analogy that I'm giving in stock. Is how do you gauge your growth? Do you gauge your growth based on unrealized gains? Then if you gauge your growth based on unrealized gains and you're in a value add deal, then your accrued preferred return is starting day one. As soon as you deploy that money is growing, but it's unrealized. Now, if you're the investor that says, hey, you know what? I am not going to start making money, real money, in my eyes until gains are realized. Then on a value add deal, you're probably not going to realize gains for year 3, year 4, or year 5, depending on the business plan. Now, if you're in a stabilized deal, you will realize your gains through quarterly distributions. So if a asset closes on June the 30th and the asset is under the ownership umbrella of that investor starting on July the 1st, and the closing of the quarter is September 30th, most likely distributions will not be paid out until October 15th. Then on October 15th, that class of investors would realize their gains. So it's really depending on how you perceive growth. Do you perceive it based on an actual payment to you as an investor, or do you gauge growth based on unrealized gains that are happening? Just like if a stock that you own is growing but you haven't really cashed it out.
Yeah. When did you realize it for yourself? I'll tell you when I realized it after, but when did you realize? And it doesn't have to just be, because in real estate there are two components, and the big two components is how much money you're going to make total from that deal, and then how much money you're going to save from that deal. So like on your side, when did you realize, when did you like have that aha moment? This like, wow, this is great.
The way I look at it is, I realize my first win is when I get a cost segregation depreciation negative K1. So tax year is we bought an asset in 2025. The CPA completed tax returns. I have a nice negative K1 for X amount. That's my first win, because I'm going to take that depreciation and I'm going to write off something else that's in my passive bucket. So it's a huge win for me. Now, if it's a stabilized asset, the second win in that line would be my quarterly distributions. Every time I'm receiving a quarterly distribution, I am winning. I am getting a return on my initial investment. My third win, that's really non-realized until you refinance or you sell the asset, is your tenants are really paying down your mortgage. I was talking to a family friend of mine, and she recently purchased a single family home, and that single family home is under a mortgage. She works for a bank. She gets favorable financing through the bank that she works with, and she was able to buy a single family home, place a single tenant in it, and there's no positive cash flow coming out of the investment because her mortgage payment, taxes and insurance equate to what she's collecting in rent. So she's not seeing any positive cash flow. So there's not going to be any quarterly distributions. And she asked me, am I winning? I said, well, in your
am I winning?
in your case, you're dedicated to a full-time job. You have an asset that's really appreciating in value at a rate of inflation, let's call it, a conservative rate of inflation of 2 to 3% per year. Somebody's paying down your mortgage at the principal rate that you're paying down your mortgage each year. So if you add the appreciation of the asset in addition to that principal pay down component, you don't have any positive cash flow, and you may not be able to take advantage of real estate depreciation because you're just a W-2 employee. But what you can do is that income that's coming from that asset, particularly, although you're not cash flowing it, there's no positive cash flow coming out of it, but you're still required to report the income of that asset. Okay. Principal doesn't forgive income. Principal pay down doesn't forgive income. So the depreciation that you're going to receive from that asset is going to offset what you're collecting in rent. So look at it this way. You've achieved 3 out of the 4 pillars. You're getting depreciation to offset your income. You're getting principal pay down, and you're getting property appreciation. If you compound all of that together and you quantify it, you're probably making a 10% return without even knowing. Yeah, you're not seeing a 10% return.
Sure.
That's being realized, because you'll realize those returns once you sell the asset or refinance it. But you're probably seeing a 10%, let's call it silent return.
Sure. Yeah.
Without receiving quarterly distributions. So to me, that's passive income.
Absolutely. I mean, we always discuss the Fantastic Four, and to me, when I realized it was on the tax side of the depreciation, where I was like, what do you mean? Because of the assets I bought, I don't have to pay $83,000. I thought it was almost illegal, but it was crazy. I was like, what? Why? So I've been doing it wrong all these years. But for me, that's how I saw it. Beside all of the amazing stuff that real estate has to offer, that's when I had my aha moment. When my wife and I, read Rich Dad Poor Dad, which made us kind of get into the real estate game. In one of the, I think it was a chapter in the book, he talked about, he talked about that one of his first deals he bought with a credit card, and he was making $18 a month. And I'm thinking to myself, when I heard that, I was like, how is that even good? Like, he's making $18 a month. Why is he even putting that on the chapter? Like, it's not even how is that a win? Now I understand that that's only one of the Fantastic Four, which is the cash flow aspect.
Yeah,
the other three he's hitting.
Barely any cash flow, but he's achieving the other three.
Exactly.
Exactly.
I didn't understand that.
Pay attention to this. This is very important. Very, very important. If you're collecting a net income from your rental single family home or condo, and that net income is $10,000 a year, and you're paying $10,000 in principal, your net cash flow is zero, but your tax obligation remains on the $10,000. Principal paydown, please pay attention to this very carefully. Principal paydown is not a write-off. Principal paydown is not a write-off. So you need that depreciation that you're going to get from that purchase to offset the $10,000 a year in income that you're making. Or the next thing you know, you have an additional $10,000 of income on your income tax that you have to pay tax on based on your tax bracket, because you don't have any depreciation to offset it. So don't confuse principal paydown for an expense. It is not an expense.
I love it. Well, there you have it, guys. It's not about how fast you get there. If you play the infinite game, it could be simple if you stick with it.
One deal a year, year 5, most likely you'll be doing 2 deals a year. Save $50,000 a year if you can. Deploy it into a real estate deal.
Yeah. And we'll have other episodes where we can break that down, how that really looks. But this is a really high level of, I think we've hit a lot of points into, what passive income really is and what it in reality could mean, right? Without showing off any yachts or supercars. If you got value from this, do something with it.
Subscribe.
Ask better questions.
And stay consistent.
Because building assets isn't about one big decision.
It's about disciplined and calculated ones over time.
If you know someone who earns well, but isn't building assets the right way,
share this with them.
This is the Cash Poor Asset Rich podcast. I'm Mickael.
This is Amer. See you next time.